Hi, thanks for the opportunity. I have a questions on a valuation, like what role does margin of safety play in our buying decision, and how do we avoid value trap in valuation which appears superficially attractive?
So Graham and Buffett and all kept saying margin of safety are the three most important words. Uh, I think we live in a world where no margins get the best valuations. So we are in a different time right now, but we are still old school. We still want protection against things going wrong, where if we buy something, then even if some of the things don't go as per our expectation, we don't lose too much. So it's key to the process that we undertake. That's primarily the reason why we are not in a hurry to deploy, and periodically you see some amount of cash. Value trap. So many a times you buy something which you think is at a discount to intrinsic value. Time goes by where instead of the market price moving up to intrinsic value, the intrinsic value starts eroding and falls below the buying price. So I would look at those kind of companies as value traps. So we keep evaluating things for bad capital allocation decision, changes in management quality, or technological obsolescence, or changing business dynamics. Hopefully we don't get too many of them, but once in a while it would be inevitable. So investing is a probabilistic kind of endeavor. Out of 10 stocks that you buy, maybe 5, 6 do reasonably good, 2 or 3 do moderately okay, and 1 or 2 may actually turn out to be bad. So one has to try and keep minimizing it, but you cannot fully avoid it because the world keeps changing. Now, if you are in an exporting company and suddenly 50% tariffs come on your product, this comes from nowhere. Or if you are in the hospitality business and COVID hits, again, you can't do anything. If you are a photo filmmaker and digital cameras take off, and again, your stock goes down. Is something a value trap or not? A lot of things are fuzzy. So some people would call something like coal assets, Coal India, a value trap. Looks cheap on price earning, good dividend yield, but people would say there's not much of terminal value. So one has to have some judgment and keep re-evaluating. So one trap that people make is people classify it as deep value or as a value trap, and then they stick with it. They don't change their label. Here, what you have to do is form your opinion, but as and when new data comes in, keep re-evaluating your opinion over time. That's the best defense against value traps.
Thanks.
Hi. I have two questions, one on a